Hello and welcome back to another episode of Fun Friday with a very special guest as always here for the show, Scott Kerico, founder and principal of Cashflow Capital Partners. How are you today?
Good, Greg. How you doing today, buddy?
I'm doing very well. We've been in contact now for I want to say about a year, been sparring with one another, trying to get you into one of our deals. We were
Mhm.
right there in the three pack, but obviously time was just a little bit finicky on that one. And you, of course, being the capital raise that you are, always are looking to move money into deals. So it didn't work out there, but it looks like we're about to partner on a deal here coming up, which is very exciting for myself and hopefully for you and Mike and Amy as well.
Yeah, it really is exciting. It's a great asset, so we're excited about it.
Absolutely. Well, tell us a little bit about yourself. Tell us about your story, how you got into capital raising, how you got into real estate, kind of the origins of what you've started here.
Gotcha. Yeah, so I came out of the pharmaceutical field. I was there for about 15 years, Greg, and I did enjoy that. But as you get into your journey, you kind of want to keep growing and doing different things. And very early on, probably when I was about 24, I was already beginning to dabble into real estate. So had bought my first rental property down in the Jersey Shore, and didn't go so well on the first one. uh, didn't screen people properly, and so we definitely had some back steps that we had to learn, and it took you're going to have some failures along the way, and we did. We did look at our product for about 5 years. The market continued to grow, and I think I call that real estate investing 101. That was my first step into learning what you need to be, what you need to have, and what you need to do to be successful. So, but it was a great learning experience, like I said, and that was my first step into it.
So what went well and what went wrong with that? Because you alluded to, a little bit of both, right? So what were the positives? What would you have done differently? What would you have avoided, I guess, in that situation, just to maybe help educate people as they maybe make their first choice as to things to look out so they can learn through you instead of the hard way.
Yeah, I think one of the first things that I realized when actually when I repaired and fixed it up and sold or rented it out was that wow, when you got that first check, wow, this actually works. And
Yeah.
so you get excited and you're like, and you start thinking, well, if we can multiply this, right, and do more, what could the future be like? So, but of course, as when you're learning any new business, we didn't screen properly in some of our winter rentals. And what happened was, we had a few tough tenants that, basically kicked our butt. And so they knew the rules and regulations of what they could do, what they couldn't do. And it was actually, I looked at it as we needed that. We needed that to grow, to understand what you write your leases or your contracts or whatever, that you have to do things properly and set things in place. And so that was a great learning experience for us. And the good thing about it was that while we lost some money during the way on the overall picture, we did because over 5 years, the value increased. And so we kind of more or less broke even, Fred. And so I look at it as that was our real estate investment.
Right. That was your MBA. That was your undergraduate degree, if you will, in the real estate world. And I explain this to people all the time that you can, in fact, lose money in real estate. And when the market is more normal and not in gangbusters, which we saw kind of post-COVID run, when
Mhm.
that happens, when that goes through, that's very rare and very unique. But in more normal times, you're looking at, hopefully 5 to 8%, which is normal growth for, basically any asset or anything of
Right.
that nature. So now that we're out of that, it's more normal, but it is good to know that it was still a positive. And that's kind of a very good lesson for anyone listening is that, hey, real estate over the time, if you do hold it and manage it, is a very forgiving business. You just got to give it some time and you will learn. But obviously, you just even breaking even there was more just breaking even. It just A, got the spark going, right? But then
Right.
B, you learned pitfalls for the future, correct?
I say that to everybody, I said real estate is forgiving, over time, if you just hold that asset, even if you pay too much, over time, you're still going to make out in the long run. So That's the great thing about it is that, you can make up ground quickly on it.
Yeah. Well, so that was obviously your first investment that you made, you said. When did you kind of get into capital raising? When did you kind of have that interest peaked? When did you get into the masterminds and kind of get that bug?
So this is really just new for us, Greg, over only about the last year or so. We had done our first deal, went full cycle, and we did fantastic on it. And the market was in our favor, and it's a good choice in the right market, and the timing was absolutely perfect. But as I started to get into learning more about the multifamily space, I also learned that you can become a great raiser and get into fantastic deals and fantastic locations and scale that way as well. And that's also, there's pluses and minuses on every, being, an operator, a direct operator, or just being, a co-GP on something. There's advantages on both sides. And so as I looked into more of doing co-GP stuff, I firmly believe that depending on where you are and, your age and your strive, it can be a great advantage of being in that sector.
Absolutely. So what was the first deal I guess you raised money for, and what was kind of the makeup of that? Because I think we were actually in Houston. I believe it was maybe in March or April, and it turns out that you raised money on at the same deal that another partner of ours, ironically, was raising on. So was that the first deal that you did that went full cycle, or was it something else?
No, so that was the very first one that we did. We purchased it, we were full GP on it. So we did raise for that. We raised about around just under 4 million for it. It was a purchase price of about 14,750,000. We had it for about 15 months. We had it in California, and they were interested in it. They had some assets up the street. They offered us 24 million, and we took it. And it was great because it was great timing. That was right before the interest rates really started to take off, and so we rode the wave, and we got in, got out at the right time. And, some people are just lucky now they're kind of struggling, but that was great. We just made under 9 million for 15 months, which is a great profit.
And then did you roll that into a new deal, or did you just cash everyone out?
Yeah, no, we had them out, and then we, personally rolled some of our proceeds into some other deals and they're spread it out in different deals that we had.
Awesome. So when you do look for a deal, what do you typically raise for? Are you only raising money for multifamily opportunities? Are you raising money for self-storage, or are you specifically just in the multifamily asset class for capital raising?
Yeah, no, yeah, we're just in the multifamily space. You feel like staying in the lane. So we look for stuff that kind of put a line that you guys class, 1990 vintage, early 2000, mild to moderate value add play on it, big cash flows, and in great locations. If it has those boxes, those are, that's 80% of the way. And then obviously, we're vetting the operator to make sure that, this is right. But, if it has those elements, obviously size and scale matter as well, but those are the things that we kind of screen it first to make sure that we move forward.
Absolutely. So what are some of the key metrics that you look for when making an investment or raising equity? What are some of the benchmarks and the kind of the green lights and red lights that you look for?
For an asset?
Or just for any investment that you feel comfortable with. Obviously, co-investing, because you obviously eat what you cook. You're always the investor in the deals that you raise for. But
Right.
what do you look for outside of the red reds? Or I guess what are the things you like? What are the things that you don't like when you're looking at a deal?
So we tend to like things that have big cash on cash, just so, if there's any problems down the road, that, the asset is generating good cash flow, that if something should come up, we have the funds to repair it or to, address it. We like assets that are probably in bigger cities, growing areas. Like I said, the vintage more for the late '90s, early 2000s that are, that don't need, um, not a we're not looking for stuff that's going to be repositioned or, stuff that's in the '70s. Not that we wouldn't look at something if it was a steal, but we're kind of staying more to the newer assets now, just because one of the first deal that we did was in the '70s, and we came across a lot of uncharted things that we didn't see.
Yeah. Well, and it's kind of funny because, much like yourself as well, we're speaking to a lot of institutional groups, of course, and the biggest thing they look for, or one of the biggest things that's even a non-starter for a lot of them, is exactly, even if it's, unless it's a how could you not a steal, as you said, 90s or newer is kind of the going standard. Now people want 1990 to 2010 is kind of that
Yeah,
20-year age range where they think is the best value and the best angle to be there. Because if you do have to hold the deal for 10 years, well, would you
right.
rather hold a deal that's a 1975 deal or a 1995 deal for 10 years? Obviously the answer is going to be the newer one, right?
Yeah, I mean, from experience, when we did our first deal, it was built like in mid '70s, and single pipes first. We had things that aluminum wiring that like had to wire address the wiring complex issue. We had you know closet doors that you couldn't even find anymore, that they didn't even make. And so we had to address headers in the building. So there was just so many things that, when you're in a '90s vintage product, you're not going to have those issues. And, how could you see, what are you going to do? Screen the single pipes every time you buy something? But you just don't know what you're going to get. You don't know what's behind those walls. So, uh, we're just going to stay clear of that. But, there's money to be made there too.
Yeah, well, and it's funny. You just never know what the deferred maintenance items are going to be theoretically for any property that you get that are going to be older. And naturally, when you do buy, 80s and older, you're gonna have to worry about boilers and chillers if you're in Texas, stab locks, just not the latest and greatest, lower ceilings. As time progresses, the
Right.
tenants are kind of gonna demand, at least 8-foot ceilings, 9-foot ceilings. They're gonna want the newer amenities and whatnot. There's only so much you can interiorly approve or improve, I should say, before you're kind of just tapped out to the property's fullest potential. And naturally, the older assets are going to get downgraded quickest and they're probably going to have the less desirable tenants. So, we want to have, newer assets, but of course, it's all risk adjusted assessment here. If we can make a ton of money on something on a '60s deal, we would probably buy it. And if returns were incredibly compressed on 2015 deal, then we'd probably maybe actually want to venture towards a '60s deal. But it's obviously nuanced and it's handicapped accordingly.
Yeah, it's case by case, right?
Yeah. So what markets do you like most? Because I believe you've invested in Florida, you've been in some deals in Jersey, we're in Texas. What are kind of the areas that you're looking at and seeing that, are kind of getting you and your team excited when you get a deal brought across your desk?
Yeah, I mean, we're really targeting the southeast of the United States. And we just recently expanded that now. So we're more like East Coast based. So anything along the East Coast of the United States and as well as Texas, because we just feel like there's a great opportunity there. It's obviously one of the fastest growing states, Florida. So we've kind of moved our view out a little further to do the East Coast of the United States and as well as Florida or as Texas.
That's awesome. And,
Yeah.
obviously Texas and Florida are seeing similar issues, right? With insurances and property taxes issues. Can you speak to any of the nuances in Florida that, that someone that is a Texas operator maybe wouldn't know, but is something to be considered if you're an investor or capital raiser looking to raise money in Florida? What are some things people should be aware of? Because obviously in Texas, we know property taxes are a big thing. We try to avoid those. Insurance, depending upon, if you're in Houston, can be pretty expensive. But similarly, Florida has probably higher property taxes as well as higher insurance risks, right? So what are some
Yeah.
of the things you have to look for in a deal in Florida that the average person may not know?
Well, I don't know if you saw that there was recently, all the condo associations are the requirements now are to hold a lot more reserves. I remember that one building collapsed in Hawaii or in Miami, and so that seems to be a big issue with a lot of the condos and some of the complexes down there. So there's a lot. I mean, obviously with the hurricane insurance and, obviously being near the water, and, all the insurance people that we speak with, they're just saying that, the replacement of these assets has gone up so tremendously that, a building that was $20 million now, to replace it is, $40 million now. And so they have to insure their insurance costs, and the repairs have to go up. And so that they have to pass that on to the operators and the owners of the building. So, I don't even think it's just in Florida. I'm in New Jersey, and, I talked to the insurance guys up here, and the same thing, a single family, 100,000, now it's 600 or 650. You have to pass that extra cost on to somebody. Because so it's going to be a tough board, because obviously inflation and everything has really hit all these markets. And so, that's kind of what it is, and where we're at with the insurance.
Absolutely. Well, it is concerning for sure. And I believe Florida now, I think as a state now, is all tier one for risk. And tier one basically means that it's, basically a inevitably and constant insurance premium factor, just like Houston is right now. And we
Right.
even in our end try to buy it in Houston where we're not on the water or in a flood zone, but still there's only so much you can avoid there. It seems like
Right.
Florida, similarly, you just can't get out
Yeah.
of paying higher insurances. And it's kind of
No.
like in Texas right now too. These are some of the best states talking about for real estate investing: California, Texas, and Florida. Granted, a lot of people are staying away from California, but just for the sake of the conversation here and the point, California is getting hit really hard with, depending upon where you're at, with earthquake insurance items, but also wildfire right now too. So depending
Sure.
upon where you're at,
Yeah.
insurance is really a big problem. I think the biggest thing people are looking at is just, as you said, replacement costs is so gosh darn high now, with labor being crazy, with
Yeah.
materials being crazy. I mean, obviously, you remember during COVID, the delay to get parts and whatnot was obviously very challenging. Of
Yeah.
course, the market prevailed and made it so much so that it didn't really matter because rents got crazy hot. But still, something to
Yep.
think about are the unseen things that someone doesn't necessarily think. Yeah, sure, everyone wants to invest in Florida, but when you look at the numbers, sometimes a deal maybe in Tennessee that's not as sexy of a market as Florida might make more sense because of these
That's true.
unknown variables, right?
Yeah, exactly. Exactly.
Yeah.
We've been trying to stay a little bit away from the water just because of all this insurance issues and all these problems that occur. So we're trying to stay in land a little bit more and away from the shores.
Yeah, one, it's kind of funny because I think Rob spoke about this many times, but when we think about Arizona, which is my home state, for instance, very low insurance costs. The only thing that happens here is that it gets oppressively hot. Okay, well,
Right.
you can solve for that. Maybe your stucco or exterior needs to get touched up a little bit more than the average state, but that's fine. But property
Mhm.
taxes here are very low. So
That's
if your
good.
property taxes are low and your insurance costs are low, appreciation's a lot cleaner. So buying here, it's
Definitely.
different. The cost per door in Arizona looks a lot higher than what it would be in Florida, the Carolinas, or in Texas, just because of those items and whatnot, which is
That's
interesting.
good. That's a good point.
Yeah. But thinking about when you do want to work with someone, because you do like to be a fund manager or and a co-GP. With that said, how do you vet a sponsor and someone you work with? What are some things that stand out to you? What are the do's and don'ts there? Do you need to have a certain track record? Do you have a long due diligence checklist? What does that look like for you?
Yeah, I mean, obviously we look at years in the business. We look at, how many actually assets they took full cycle, right? We also look at, the assets and where they're investing, right? So we try to stay in the markets that we know are growing and there's a lot of opportunity. We know there's going to be continued growth and good employment, right? We like to, we like the Houston market and stuff like that. We just know that those markets are always going to be solid, and those are the things that we tend to look for. I'm trying to think what else, the synergies between, the operators, how do we feel and how they feel with us, right? When we meet them, do we feel like they're kind of, you know, have the same goals and dreams that we do. We care about our investors first, and we make sure that they're happy and they make money. And if they're happy, we're happy. And that's our goal, is to really put our investor first. And that's, over the last 4 years, 4.5 years, we've made, ultimately very happy.
That's awesome. So, how do you find your investors? Is this friends and families and networks, or referrals and whatnot? Is this people you've done business with before your colleagues and whatnot? Because you have a big team. It's not just yourself, right? You've got a couple of partners there. But what do you guys, where do you find your partners, your sponsors, everything like that, and then
Yeah,
investors?
a little bit of both. A lot of it is through, people we know. And, one of the great things that I always tell, the other team members is, when we get an investor and, they're on board and they're happy, just say, hey, is there anyone else, friend or family that would like to join us in the partnership? And, we usually get a few names, and then, just that introduction, when we speak with them on the phone, the level of trust is already, at a higher level than if you're just networking, or you're trying to, do social media or something like that, or you meet somebody you don't know at all. So, those relationships take some time sometimes to develop. So, we've been very successful in going through our local and markets, and also people that we know from our area and business contacts that have helped us scale and raise money a lot faster than some of our competitors. So um, that's probably the process. We did hire a company just recently. Now they're going to do more of a social media presence, and we're starting to expand out into all the different social media platforms to continue our growth with the company.
So, right. So do you do kind of more of an old school kind of approach where you pick up the phone and call people? Do you kind of do email campaigns? Do you have a more formal CRM system? What does that look like for you guys when we do have a hot deal that you want to raise for? Is it just, hey, you call kind of the old reliable, you call people that I've worked with in the past, or what is your search looking like on that end?
A little bit of both, I guess. I do a lot of texting, believe it or not, because I just feel like when you send emails, sometimes they just go into black hole. But for some reason, when you text somebody, they tend to respond more. So I use a lot of texting to at least get a response, and hopefully when we get a response from that, we move to the next level. Um, so word of mouth, phone calls, of course, texting, email, yes. But that's been seems to be working pretty well for us.
With that said, what do your investors look for typically? Are they looking for cash flow? Are they looking for, wealth, or I guess equity multiple? Everyone is looking for a different deal profile, right? But what are the things that you harp to your investors? It could just be safety of a deal and basically just really good risk adjusted returns. Everyone looks for different things, but I'd be curious to know what you and your people kind of see and what they seek.
It's a tough question, Craig, because if we have a younger investor and they're just looking like, I just want to make as much money as I can, I want to double, triple it. And then you get an older investor and they're looking more for cash flow. They're, at the end, they're more towards the end of their working years. And so they're looking for the highest cash flow. It's hard to say. We have stuff that's all over the board, but I usually, for me, when I see somebody a little bit older, I kind of know that they're probably leaning more towards cash flow. And somebody younger is probably leaning more towards, net worth and equity growth. But not always, right? So it's hard. It's case by case. When we interview them, we have a call. We ask them, what is the biggest thing you're looking for in your investment goals? So, and we let that come, right?
Right. And I'm always so surprised too. And I'm always interested to hear what people raise money think from their investors and whatnot, what they look for, because I know our folks are a diverse bucket. Some people hate taxes with a burning passion, and they need to avoid paying them in any way, shape, or form as they're real estate professionals, and they can utilize some of the loopholes we have at our disposal here. Some people are looking for cash flow, and some people are just looking for equity growth long term. So they don't care about
Yeah,
any cash flow. They just want to play the game
exactly.
of how can I get as wealthy as possible, and I'll deal with the cash flow later because I'm working right now. So I'm just looking to have my money grow. So there's different strokes for different folks.
Yeah, and that's why a lot of times, like, well, when we offer different deals, we maybe offer two deals simultaneously because one could be more skewed for equity growth. You want it to be more heavy on the cash flow. And then, somebody comes in to us and says, "Hey, I'd like to invest, 100,000." I'll say, "Well, what are you looking for?" "I want, high, cash on cash." "Okay, well then now this deal has to be a little bit better for you." Or, "No, I want more equity growth." Well, then we steer them this way. So we have a little bit of different options to offer our investors, and I think they like that.
Right. And how many deals do you typically want to do a year? I mean, obviously, if there's a bunch of good deals, you're getting good deal flow at this point, right? If you can raise money, deals will find you. So, how many deals a year are you typically looking to do right now? What would you like? And, how many states you want to be in? What is that looking like for you as you kind of look to navigate and steer towards a successful 2024?
So right now we're going to have your deal, and then we have a deal in New Jersey. So we're raising for that. So we have two, and then we're kind of finishing off another deal. We just have a little bit left of it. So we have three, but we only have two. So I don't know, maybe 4, 5, 6 deals a year. I think that'd be plenty to raise for.
Absolutely. So basically, one every other month is what you want to do, or just around that kind of point.
Yeah, I mean, we like the nice thing is that we can be selective, and if we don't really like where the asset is, or it needs it, or we can decline it. I know you guys had some deals, and we looked at them, and some of them were a little bit older, or we didn't really like it. But we like some of the other deals that you did do. So
Awesome. Yeah. Absolutely. And with that said, what do you think will do best asset class wise coming up? Do you think, there's some assets, whether it be, call it, office compared to multi or mobile homes, what do you feel will do best? Obviously, you're just really singularly focused in for multifamily for capital raising, but obviously you've invested in single family homes, you've invested in other stuff, right? So what do you think will do best here coming up as we're kind of going into the recession?
Right. Well, obviously multifamily, right? Multifamily, we know is warehouse is going to do phenomenal. Self-storage is probably going to do really well. And we know the office space and then the retail space are going to take a beating. Just the way, things are set up now. And, I see a lot of, saw some shows the other night where they're trying to take office space and reconfigure it into multifamily in the city. And, the cost is just astronomical, because if you have, you got an office building with 2 bathrooms in it, you need 10 on that floor. And it's just the cost to do that is going to be unbelievable. So, but they're trying different things. And so who knows what they'll actually come up with. But yeah, I mean, we kind of know, multifamily, the warehouse, the self-storage areas are fantastic. And some of the other ones are going to probably suffer some issues.
Yeah, well, no, and I think it's the worst kept secret that office is going to be doing pretty poorly here coming up. And I just, for the life of me, for what it's worth, never figured out those who want to take on the endeavor of an office conversion. I just don't see that really making sense. As someone who's been in residential real estate before and understands the nuances of square footage, how that works, needing lighting, natural lighting, plumbing,
Right.
how to make spaces functional. I don't really see office spacing being rendered useful in that regard. It's going to take a big lift to get there. So I think it's a very ambitious thing. And I think it's really wishful thinking to think that you're going to get someone that wants to, do that and do it consistently. It just doesn't make sense. So it's going to be a challenge for all those people who have these office notes and whatnot. And I'd be curious to know if there's any government intervention in the space coming up there to kind of help that, those problems coming up. But it's definitely a looming issue that there's going to be a hat to drop, and we're going to be all patiently waiting on the sidelines here to see what's going on. But thank gosh that we chose a different space and are not head deep in that one, huh?
Yeah, I mean, you see it even in the mall space, these big malls, and now they're trying to build, multifamily above it. And, I mean, it can be done, I guess, but like, what's the cost of that? And are they going to have adequate parking? And so there's just so many things that are like, that you have to think of to, do something like that. So I guess they're trying to help these malls out by putting multifamily above it, so they come down and use the services in the evening and stuff. So who knows what's going to happen, but I know they're trying.
Yeah, well, and it's funny. Retail space is definitely a tricky one to crack, and it definitely seems like Amazon is naturally a big disruptor, and just generally e-commerce is changing
Mhm.
the way a lot of things is done. I'm personally someone that likes to go when I buy clothing in person to shop, but that, I guess it's just me, and most people buy things via Amazon these days. But naturally, we have to wear suits with what we do, so you can't really Amazon a suit. You got to go in
Right.
there, get it done in person, and I do like the in-experience shopping, but with the exception of basically Lululemon and a couple other stores, I don't know how everything's going to have to fit me a certain way. So only a couple things I can order online for it to make sense. With that said, what is also making you, most nervous about the recession coming? Do you have any deals or kind of markets that you're kind of circling like, ooh, I don't think it's going to do well, or are you more just excited for the opportunity to come from your perspective?
I think that, I get frustrated with the media sometimes because, like, when the media is constantly pounding the consumer, it's going to be a recession. The recession's been coming for 3 years. I don't know. is it
Yeah, I
is it
know.
coming? Is it not coming? I don't know. But they've been pounding the media for how long? And it scares the investors sometimes. I always say, what does a person do that's scared or confused? And I always say they don't do anything, right? They just kind of sit on their hands. So that's the biggest frustration. People will talk to them and they'll say, "Hey, what about the recession?" And I'm like, "What recession? I don't know. I mean, recession's been 3 years, and is it coming? Is it not coming? If it's a good deal and it makes sense, you invest in it. If it doesn't, then you don't. So I don't know. I'm more scared about the media does to the investors and what they perceive and project now.
Yeah, and I think you raise a good point there is that you can basically what you're alluding to is that you can make money at any point of the cycle. Okay, because you could buy an opportunity where there's a value add opportunity where there's, rents are $1,000 and clearly see that, market's about 1,200. Okay, we extrapolate that across 100, 200 unit property. Okay, well, there's a big discrepancy in value creation to be done there on top of, organic rent growth, so on and so forth. So there's always a deal and an opportunity to be had, and money does need to be circulating, and money does need to be fluid. And I think there's a lot of money that's been sitting on the sidelines that is just waiting to be peppered and pounded back into the market. And I think when it
Right.
comes to limiting beliefs right now, I think the biggest thing I really want to stress to everyone is that, hey, we printed all this money. Well, guess what? It's going to have to stick somewhere, and it's going to stick directly
Right.
into those who've got money in the markets, because I just don't see a big evaporation of money occurring. Obviously a black swan event could
Right. Right.
happen. We could get into a war, but I just generally think that we're in a situation where money is going to stick, pricing and money got printed, and real estate is where prices are going to stay high. And you just look at anything
Yeah.
else. I mean, the cost of goods is just, pretty high and expensive. I think it's just going to be the new norm. So that's kind of my
Yeah.
take there. So with that
Yeah.
said,
I agree.
on the flip side of things, what's making you most excited about the opportunity cup? Because the market is shifting. You obviously are seeing cap rates getting a little bit higher. Debt obviously kicked a bit up recently, as we were just discussing before going on air here. Debt is a little bit, less appealing now than it was before.
Right.
But what's getting you most excited for the opportunity to come? Because naturally, recession is also another word for opportunity. Some people feel
Right.
so. How are you looking at that? And what's your mindset right now as the market is theoretically changing?
Right. Yeah. No, I think and that's the whole thing. And, I think some people are going to be heading for the doors, and that's where the opportunities are going to be. And some people are, they're going to want to get out, and, they'll do anything to get out. And we had a couple of deals, that came over a couple of weeks ago, and the operators were losing it, and they were desperate to try to liquidate it and get out. And so you're starting to see some of those opportunities come now where, maybe they were making some type of bridge loan, and, they overpaid and they didn't get the rent increases that they anticipated, and the expenses went up, and so on that we know. And so those are going to be opportunities that are coming back around to the operators that are making good choices. And so it'll give us more opportunity to pick up better deals. And, so we're excited about it. I'm sure you guys are as well, because, we're going to be partnered with you guys, and, everybody wants to win the situation for everyone.
Yeah. And you've been through a couple of recessions before. I mean, you've obviously seen the GFC. I imagine you're around for the dot-com boom and can remember
Yeah.
that, and maybe one
Mhm.
other more potentially. But these are very clear points in time, right? What are some, I guess, maybe nuggets and tidbits you can kind of share for the audience as to how you've navigated recessions before, what you've done before in the past that you do again, what would you do differently? How are you assessing the situation and kind of going to play offense and kind of make the best moves possible and play offense as opposed to getting defensive and having to kind of just bail water out of the boat as opposed to
Mhm.
building a bigger foundation.
Mm. Yeah, I mean, just do, if it's a good deal, you can, move forward, right? If it's not, then don't. If it's going to put you in a position where, you're stretching or you're not unsure, I would just focus on only doing good deals right now. You don't have to, stretch and do something that's nuts to risk what you have. The recession, the ones that I went through, I've seen a lot of uh, family and friends go through different at times, like where they lost everything and they stretched too far, and control leverage and making smart decisions and not doing things that are crazy and that will put you in a bad position are key right now. So that's how I feel. There's always going to be recessions and recover from different times. So just be patient. Don't rush. You don't have to rush out. You don't have to get in today, tomorrow. Time is your friend, and just ease into it.
Right. I love that. And are you doing anything different this time around? Considering everything going on, were you saving up cash leading into the moment where, you're starting to see things change? Have you kind of been preemptively pairing up for this, or are you pretty agnostic and you just kind of live your life day by day and don't want to overthink situations?
Um, you know, if we feel like it's a good deal, like just I had mentioned before, we'll move forward with it. If it's not, or we think it's more of a high risk investment, we won't do it. We want to stay in the area, good locations that have good growth and that are more safe, and we don't want to risk going into areas that are more subjective and you know uh, basically you're not sure what the growth is going to be in that market or whatever. So uh, just stay in the areas that and I think things will work out in the long run for you if you just be conservative.
Absolutely. I love that. I like to ask this question at the end to all the guests, and is what is your hottest real estate take? If you're familiar with a hot take, it's basically just something that maybe could be controversial to some people, but for you, it's kind of a core belief. So my biggest core belief right now, something I think was thinking about was I actually kind of thought bonus appreciation was going to come back. My hot take recently is that was kind of a way for the powers that be to keep the powers in office currently with regards to, okay, well, what if we just cut interest rates and we add back 100% bonus depreciation? Well, we can artificially kind of pump the market back up. So
Mhm.
I thought that was, kind of a lock shoe-in when that was being announced, because I didn't think it was a coincidence that if the administration that took away that bill was going to bring it back, that was going to happen. So it seems like that's only inevitable and is going to be passed through here coming up. So
Mhm.
that was kind of my core hot take there. But I was wondering if you also had some sort of take that was unique to yourself, or maybe one of your philosophies that you'd like to share with everyone here.
Yeah, mine is more about mindset, Craig. I feel like you're going to have this journey, and you're going to make mistakes. I mean, it's just inevitable. Everybody does. There's nobody that's got into any of this business and hasn't made mistakes. You just try to minimize them, and when you get into a situation, you just try to overcome them, adapt and overcome that situation. That's basically what you're doing. You're just overcoming these obstacles that come to you. Um, you know, it's just stay focused on your goals and your course, achieve your goals. And you heard the saying, greatness is from small beginnings. You could be starting out very small here, and you could grow. It's just a massive, just believe in yourself, and you keep continuing on the road, and you will have some failure, but that's how you keep moving forward, right? We've all been there. We've all had setbacks. We've all had failures in life, but it's the ones that we can overcome and move forward that make greatness. So.
I love that. Yeah, well, you're absolutely right. You can't, buy 100 deals without buying your first. You can't get to where you need to go without just taking the first step. So I love that. Scott, thank you so much for coming on the show. Where can people find you, get in touch with you, and connect with you if they want to reach out?
So you go to our website at www.cfcpartners.net, and that will give you the latest deals and opportunities for investors and investors if you haven't heard there, and we can drop on it all.
Absolutely. Well, we'll put that in the show links. Scott, thank you so much for coming on today. I look forward to hopefully seeing you soon and partnering on our first deal here together in 2024. See you next week, everyone.
Thanks, Greg.